Corporate insiders are selling at the most rapid pace in over 20 years. This chart shows the ratio of corporate executives who are net sellers versus net buyers of their own company's stock. This ratio has only gone above a ratio of 4 a handful of times over the past 2 decades, and is now at an all-time high. So it's a fair question to ask whether high-level corporate insiders have access to inside information that's pushing them to sell at a historical pace today. Corporate insiders, like CEOs and board members, know their companies inside and out. When these leaders start selling large amounts of their own company's stock, many investors see it as a warning sign that the stock market might be in trouble. One of the most well-known corporate figures, Warren Buffett, is holding a record $325 billion cash pile today. Buffett's cash allocation is now at 30% of Berkshire Hathaway's total assets. As a major shareholder and decision maker in many companies, Warren Buffett's actions, like raising cash, factor into the insider transaction data. The last time that Warren Buffett raised so much cash was between 2004 and 2007, a 3-year period where his cash allocation stayed quite consistently above 20%. Soon after, the 2008 financial crisis occurred, and that's the moment where Warren Buffett finally deployed his cash and reinvested his holdings into stocks. Could it be that corporate insiders like Warren Buffett are selling stocks and raising cash today right before a market downturn? Not necessarily. The data could suggest something much more simple. The market's been on an absolute tear in recent months. With stocks having risen this much, insiders might just be doing what any rational investor would do, booking profits. While companies' fundamental business operations don't change dramatically month to month, their stock prices sure can. So when share prices go up 20% or more, insiders can take the opportunity to lock in some gains. It's basic profit taking. Given that the stock market has been incredibly strong since October of 2022, close to a 70% return in just over 2 years, it only makes sense that corporate insiders would be taking advantage of that strength to sell some of their stocks. But there's another explanation for this surge in insider selling. Some corporate insiders may believe that their company has become too expensive relative to what it's worth. The stock market as a whole is getting quite expensive today. When we look at forward PE ratios, it's at one of the highest levels in history. This ratio compares the current stock market price to its predicted earnings for the next 12 months. It shows investors today are highly optimistic about future economic growth, a similar level of optimism to what we saw in the late 1990s. Back in 1999, investors bid up the price of stocks to extraordinary levels as they believed that the internet would transform the economy overnight. This speculation drove the stock market PE ratios to 24, historically unprecedented levels. Today, PE ratios are approaching those 1999 levels. It's possible that insiders are seeing these high valuations as an opportunity to sell some of their stock, but history shows that high valuations are not a great sell signal for the stock market. In 1997, the stock market already reached quite extreme valuations, but the mania continued for another 2 years. It's not impossible that we see something similar happen today. Corporate profit margins are quite a bit higher than they were in 1999, which could give the markets an excuse to exceed that high if the environment stays favorable. Companies today are operating with much greater efficiency, leveraging technology, automation, and now AI to reduce costs and boost productivity. The rise of software has created business models with far higher margins than traditional companies of the late 1990s. While tech companies in 1999 were burning through cash to build infrastructure and acquire customers, today's tech giants have established strong businesses that generate substantial free cash flow. This could actually justify higher valuations than in 1999, which would mean insiders are early to sell their stocks. Another argument for why valuations could actually continue moving higher is that the Federal Reserve is projecting to gradually lower its interest rates over the next year, just like they were doing in the late 1990s. When we look at what the stock market usually does in these type of environments, where the Federal Reserve is cutting interest rates without the economy being in a recession, you can see all of these periods highlighted right here. In all of the cases where the Federal Reserve was pausing or lowering interest rates without the economy being in a recession, the stock market tends to do really well. But when a recession finally does come, it drags the stock market lower, in some cases significantly lower. So is this what insiders are preparing for? Are they selling their stocks just before a major economic downturn occurs? Historically, corporate insiders haven't had a perfect track record in timing market downturns. Looking at the past 20 years, insider selling has only surged above a ratio of 4 in 4 periods: 2005, 2014, 2017, and 2021. When we look at what happened to the S&P 500 following these periods of excessive insider selling, each time it preceded big cyclical market tops. But actually, history shows that the time between these periods of insider selling and the market tops can be very long. In 2004 to 2005, corporate insiders began aggressively selling their shares. The market continued rallying for 3 more years before the 2008 financial crisis hit. If you had sold when insiders first started selling, you would have missed out on substantial gains. And this pattern repeats. Insider selling spiked again before the 2015 earnings recession and the 2018 US-China trade war sell-off. We also saw a surge in 2021, before the Fed's tightening cycle. Tech executives like Jeff Bezos and Satya Nadella sold massive blocks of shares throughout 2021, but the market didn't peak until months later. So in many cases, insiders have sold well before a top, and stocks kept climbing for months, sometimes years afterwards. When we look at these periods of major selling activity, there's no consistent correlation that indicates insider selling always triggers an immediate bear market. Thank you for watching, and we'll see you in the next video.